Ladies and gentlemen, good day and welcome to the Q1 FY26 conference call of L&T Technology Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandesh Nayak, Head of Investor Relations. Thank you, and over to you, sir.
Thank you, Rayo. Hello, everyone. I am Sandesh and welcome you all to the earnings call of L&T Technology Services for the first quarter of FY26. Our financial results, investor release and press release have been filed on the stock exchanges and are also available on our website www.ltts.com. I hope you've had a chance to go through them. This call is for 60 minutes. We will try to wrap up the management remarks in 20 minutes and then open up for Q&A. The audio recording of this call will be available on our website approximately 1 hour after the call ends. With that, let me introduce the leadership team present on this call. We have with us Amit Chadha, CEO and MD, Abhishek, Executive Director and President, Alan Saxena, Executive Director and President, and Rajiv Gupta, CFO. We will begin with Amit providing an overview of the company performance and outlook, followed by Rajiv, who will walk you through the financial performance. I now invite Amit for his opening remarks.
Perfect. I hope I'm audible and you can hear me fine. So thank you all for joining us on the call today. First, let me provide the key highlights on our Q1 performance. In US dollar terms, our revenue was up 13.6% year on year, while our Q1 Smart World seasonality predominantly impacted revenues to decline by 2.9% quarter on quarter. Our major markets of North America and Europe continue to grow sequentially. Our most profitable segment, sustainability, grew 16.4% year on year and 4.1% quarter on quarter to cross the 100 million quarterly milestone and is now a 400 million plus annual business on a run rate basis. Therefore, all three segments are at 400 plus annualized revenue. Based on targeted efforts to pivot on growth and improve our market share, we continued with the large deal momentum in Q1 to surpass $200 million in large deal TCV for the third consecutive quarter, which includes 150 million deal, 3 20 to 30 million deals, and 6 10 million plus deals. Again, for clarification, we will, going forward, report LD TCV, which is large deal TCV, and these are deals above $10 million each. Our go-to deeper scale strategy and proactive investment in new age technologies are leading to stronger partnerships with clients and a robust TCV booking. The LD TCV booking and TCV booking. The EBIT margin held at 13.3 for the quarter. This is in spite of the revenue impact of SWC seasonality, headwinds in the mobility segment, and support extended to strategic customers as highlighted in the previous earnings call. We expect EBIT margins to see an improvement in the coming quarters as growth gets broad-based across segments. Now, a few headlights and highlights on our technology and innovation charter. Today, our engineers have deployed multiple programs for clients in AI and have filed 206 patents in this domain. AI is also becoming central in our deal wins and in establishing strategic partnership with our clients. Additionally, we are launching Plex AI, our proprietary AI framework which accelerates product development lifecycle for global customers. Plex AI combines smart prompting, contextual intelligence, and agentic workflows to significantly reduce product lifecycle. Plex AI was originally incubated in the mobility segment, but has now been scaled and propagated to other segments using a multi-vertical cross-pollination approach. Overall, patent portfolio stood at 1550, out of which 952 are co-authored with clients and the rest are filed by ltts. To address specific areas of client investments, in the US market, we inaugurated a new design center in Plano, Texas, focused on cutting-edge technology, cybersecurity, and AI. This will help us to expand our footprint in our key market, helping us gain further market share. As an ITAR-compliant facility, the center is also equipped to design, develop, and test defense-related products and systems. This investment, made ahead of the curve, underscores LTTS's commitment to delivering advanced solutions in AI and tech and establish much more nearshore centers tailored to evolving needs of our clients. With that, let me move to segmental performance and outlook. We'll start with mobility. So starting with some good news, the trucks and off-highway and aerospace and rail subsegment grew well sequentially and year-on-year for us. The auto segment continues to be in flux, and let me provide some color around BEV, hybrid, and ICE. China's alternative low-cost innovation and stack in this area is creating disruptions to existing industry, causing further challenges to establish global players. There is continued demand by consumers to get more SDV features, which with high cost of ER&D of development of OEMs in US and Europe is becoming slightly difficult. Our investment in building solutions like LTTS iDrive and stacks for EV and hybrid, coupled with our offshore delivery model, which provides a lower cost model as compared to a completely on-site model, have positioned us as a partner of choice for our customers, basis which we continue to win new programs, which I will detail in a bit. There is, however, a short-term pause on some programs and delayed starts in others. We expect these dynamics to keep automotive muted in the short term for another couple of quarters, with growth returning after that. On to the deals we have won around SDV, AI, next-gen product development, software design, and digital engineering include a multi-year deal with a US automotive components maker to deliver engineering support, including ASPICE compliant systems, software functional safety, cybersecurity, and quality assurance. We've been named a strategic supplier for ThyssenKrupp Steering and Traton Group. A satellite company awarded LTTS a significant deal for software design, development, and embedded engineering for airborne systems. Overall, the mobility segment, we have won 5 10 million plus deals in Q1. This vindicates our solution stack, and we are actively engaged in securing many more deals. The pipeline in mobility overall remains robust, with a lot of action in auto, T&OH, aero, and rail. We continue to work with our clients to get these to closure. We believe that overall mobility will stay muted in the near term and expect turnaround in the second half of FY26. Coming to sustainability, the sustainability segment did well with 16.4% year-on-year and 4.1% quarter-on-quarter growth to cross the 100 million milestone for the first time in a quarter. The large deal closure in the previous quarters are ramping up, leading to further growth during the year. More than half of the large deals won in Q1 are in the sustainability segment, which is our highest profitable segment. Sub-segment details. In plant engineering, we continue to see strong demand in oil and gas and CPG, led by greenfield and brownfield capex projects. We are also seeing ongoing demand in plant modernization for increased efficiency, sustainability, and safety-led projects for legacy plants. Key clients continue to ramp up with us. In fact, Q2 will see us back with a 50 million account on an annualized run rate basis, which is a milestone that we should all be happy and proud about. In a large deal of $50 million, we were chosen by a global energy major for enterprise data and digital services based entirely on our proprietary tools. Moving on to the industrial sub-segment, we continue to see ramp-ups of large deals signed and a robust pipeline of deals going ahead because of our AI-led interventions in the PDLC offerings. A couple of details. We have signed a strategic agreement with Tenant Company to advance sustainable new product development. we will set up a dedicated offshore, or have set up a dedicated offshore engineering center for them. Second, we have also signed a definitive agreement to support product sustenance and lifetime development for a semiconductor equipment manufacturing company across multiple product lines. Overall, for the sustainability segment, we see an increased large deal pipeline and expect the growth momentum to continue with both industrial and plant subsegments doing well this year. Now to tech. The tech segment grew 29.4% year-on-year as it includes the benefit of IntelliSwift revenue for the quarter. Though as expected, Q1 is down sequentially on account of seasonality of the Smart World subsegment. With the integration of IntelliSwift complete, the software and platform subsegment with its software and agentic AI offerings has seen a good response from our customers across hyperscalers, fintech, and healthcare. The media and tech subsegment continues to evolve with new technology areas and experiencing significant transformation driven by advancements in AI and immersive technologies. We continue to grow in the US market and have seen some traction in our semiconductor accounts. We are pursuing some deals in this area and expect to close them shortly. In the medtech subsegment, demand is being led by AI investments across digital manufacturing, sustenance engineering, and Quara. All of them have shown good growth despite some delays in decision-making in the US market. We have onboarded new logos, especially in ophthalmology space, which should aid further growth. Overall, medtech is expected to grow further in the second half of the year as we look forward. In the Smart World space, we have developed a domain-centric computer vision ops platform applicable for urban and smart spaces, public safety, energy utility, and manufacturing. We recently won a Safe City project in India, leveraging AI and analytics to enhance public safety with an adaptive travel and traffic control system. Our foray in the Middle East is progressing, setting up a strong foundation with a pipeline, and we expect that FY26 will be the year when we start revenues from the Middle East. In the tech segment, there are various large deals in advanced stages of negotiation, which we hope to sign off in the coming months. This will help us continue tech's growth trajectory from Q2 onwards. Before I come to outlook, let me provide some overarching color on the state of the market as we see today. One, given the dynamic nature of the market, our clients are still a little cautious on decision making. But based on multiple conversations and a confidential poll that we ran across our client base, a large number of our clients see things stabilizing, and as a result, H2 potentially being better than H1. Two, we are seeing AI become a central area of focus with our clients. The AI wave of engineering ER&D is beginning to gain traction, and this is on account of enterprise tech leaders who believe that they are behind their peers in embracing AI to accelerate product development and improve productivity. The poll also finds that 30% of the clients are engaged in full-fledged AI programs, while others are still in POC stage. Therefore, the AI spend appears to be real. This is resulting in deals and programs coming up for bids and rebids. Third, the setting up of localized and regional supply chains along with software-defined everything, industrial automation in the near term, and robotics and humanoids in the medium term will continue to drive spends. With that, let me discuss our outlook. Our unique, balanced three-segment approach allows us to grow in a de-risked manner and safeguarding us in the current uncertain market environment and tightened demand conditions. I am encouraged by our robust backlog order book, which has been increasing quarter-on-quarter and year-on-year, and a healthy pipeline of 50 million plus deals slated to close in the coming quarters. Backed by increased order book with a focus on resilience and profitable growth, we look forward to a double-digit growth over FY25 while maintaining a medium-term outlook of $2 billion of revenue. Thank you all for your continued support. With this, I'll now hand over the call to Rajiv and then stay back for questions. Thank you so much.
Thank you, Amit. Greetings to all of you. Let me begin with the key highlights for Quarter 1 FY26. Our focus on growth
has led to another quarter of healthy large deal wins over $200 million, which provides comfort that H2 will be better compared to H1. The sustainability segment now stands at $100 million quarterly run rate, and all our three segments have crossed the $400 million annual run rate. This vindicates our diversification strategy and a well-balanced portfolio, especially during these dynamic times. This quarter saw 13.6% year-on-year growth in dollar terms, though there was a decline in sequential revenues due to seasonality of Smart World business, headwinds from macro environment and challenges in automotive sector. Despite these challenges, our margins have been resilient and stable compared to previous quarter. We continue to innovate and build next-gen solutions. Glad to share that we've been recognized in the leadership quadrant by ISG in Aerospace and Defense Services 2025 in Europe and by HFS in Engineering Research and Development Service Providers 2025. With that, let me take you through Q1 FY26 financials, starting with the P&L. Our revenue for the quarter was INR 2,866 crores, a growth of 16.4% on year-on-year basis, and a decline of 3.9% on sequential basis due to reasons mentioned earlier. Our EBIT margin for the quarter came in at 13.3%, which saw a slight improvement over the previous quarter. We expect margins to show gradual improvement from here on. Moving to below EBIT, talking about other income was 51 crores, higher on sequential basis, majorly due to forex gains. Our effective tax rate for Q1 was 26.9%, better compared to our expected range of 27.5%. Net income for quarter was INR 316 crores, up 1.5% on quarter-on-quarter basis, which is 11% of revenue. Moving to balance sheet, let me highlight key line items. Our Q1 DSO was at 98 days compared to 88 days in Q4. Unbilled days at 17 in Q1 compared to 18 days in Q4. The combined DSO including unbilled stood at 116 days compared to 106 days in Q4, which is still within our target range of 110 to 115 days for the year. We expect this to improve as the year progresses. Our free cash flows came in negative 28 crores due to seasonality of our Smart World business. Our cash and investments stood at 2,431 crores at the end of quarter 1 versus 2,981 crores at the end of quarter 4. This is an account of payment of dividend and balance consideration of Intelliswift acquisition. Moving to revenue metrics, in dollar terms, we reported revenue of $335 million compared to $345 million in Q4, decline of 2.9% in reported terms. Talking about segment margin performance for quarter 1 FY26, mobility segment margins for Q1 came in at 15.3%, lower compared to previous quarter, stemming from delayed decision makings of large deals, pauses in existing programs, and discounts being sought by customers. Sustainability margins for quarter came in at 27.4%, showing a significant improvement due to ramp up of large deal wins in both sub-segments. We are witnessing healthy pipeline and deal closures in this segment, which will continue to aid revenue growth and margin improvement in the coming quarters. Tech segment margins for the quarter came in at 9%. Pleased to share that our integration plan for Intelliswift acquisition is on track and showing improvement in revenue growth and margins. Though we saw a decline in this segment in the margins compared to previous quarter due to continued strategic support for select programs and customers. Moving on to operational metrics, the on-site offshore mix showed slight improvement towards offshore compared to quarter 4. Offshore percentage now stands at 56.1%. The T&M revenue mix was 62.2% in Q1, slightly higher compared to quarter 4. With respect to client profile, which indicates number of $1 million plus accounts, showed a sequential improvement in the 10 million, 5 million, and 1 million category. The client profile will continue to improve in coming quarters. Our client contribution to revenue was slightly muted compared to quarter four in the top 20 category. We expect revenue from top customers to improve going forward as we're running targeted programs on client mining. Headcount came in at 23,626 in Q1 compared to 24,258 in Q4, while attrition came in at 14.8%. We've been leveraging AI and automation for customer projects and also driving internal efficiencies. We now see a trend of non-linearity between revenue and headcount. Realized rupee for Q1 was around 85.48 to the dollar, an appreciation of around 1.1% versus quarter four. Before I conclude, let me provide visibility on the margin trajectory going forward. We expect our EBIT margin trajectory in H2 to be better than H1 based on continued momentum on large deal wins, revenue growth in higher margin segments, and leverage on operational efficiency, including AI-led automation. We continue to aspire for improving EBIT margins to mid-16% levels between Q4 FY27 and Q1 FY28. Thank you. I now hand it over to the moderator for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from Manik Taneja from Axis Capital. Please go ahead.
Hi, thank you for the opportunity. First question was for Amit. Basically, some of your other peers seem to be slightly more positive with regards to the automotive passenger vehicle demand, while your commentary seems to be slightly more somber. If you could just talk about this customer-specific impact that because of which you see a more muted performance. That's question number one. The second question is with regards to the margin outlook. And while we continue to retain the mid-16% EBIT margin target by Q4 27 or Q1 28, just wanted to understand if you could broadly talk about how should we be thinking about the scope for recovery across gross margins and SG&A on a go-forward basis.
Okay. So, Manik, first of all, on a lighter note, we don't do automotive only. We do a lot more, right? We're a diversified player. So the good news here. Now, if I specifically talk of auto, see, I'll tell you generically, and I'm not talking ltts clients specifically, US automakers are in a flux because they were investing in EV till 2 quarters ago and now are not sure whether to continue invest in EV or should they go back to ICE, right? Number one. In the case of European players, which is facing competition from China and the Chinese stack and the EV stack, the China EV players are selling cars at a third and a fourth of the price of the same cars available from the European OEMs. That is putting immense pressure on them to reimagine the stack. At the same time, SDV features that were being rolled out by US OEMs and European OEMs are being pushed out because of the dynamics in the market. So that is creating the pauses, that is creating a little bit of dynamism, shall I say. Now the positives are that traditional European ER&D players and the small amount of US players, and they are very few and you are aware of it as well, are unable to service the later gen offerings that are required by the OEMs out there. That is creating an opportunity for companies like LTTS and our peer group. We also announced a 50 million win last quarter, just before the quarter ended in auto. I reaffirmed that we had, in terms of the wins we have had in this quarter, I am being cautious on grounds of prudence in the auto sector. The deals are robust. The pipeline that we have got is robust. Now it depends on what will close when, and if it does, it will turn out as an upside for us. So that's broadly where I am on auto. I also want to reaffirm to you, we have not paused any investments. In fact, the Plex AI tool came out of mobility. We could have killed it, thinking that nothing will happen in mobility right now, but we've actually taken it forward. Second, LTTS iDrive 1.0 was launched last year. LTTS 2.0, iDrive 2.0 will be launched in the next 2 months. We already have production customers for LTTS iDrive 1.0, and we have customers lined up for LTTS Drive 2.0 as well. So signs, like I said, market a little bit of flux, but there is an opportunity. Let us see where it goes. The year is to be played out. Rajiv, I'm going to hand over to you for the margins.
Sure. So, Manik, to talk about the margins, there are various levers that we are continuing to work on. First, of course, the growth and quality of revenue, right? We've been talking about large deal wins, and particularly we are seeing good traction of large deal wins in sustainability segment, right? Which is, of course, going to improve the mix of revenue within high margin segments, leading to improvement in margin. That's one. Second is, we've talked about productivity levers, so operational efficiency, be it in terms of pyramid, fresher intake, offshoring, looking at automation, AI, etc. These are areas that we continue to work upon. Third, from an SG&A standpoint, I would guide that you should model between 10.5 to 11.5% of SG&A cost. Fourth, we've talked about IntelliSwift integration plan. This is an integration plan that we built for the next 8 quarters, where you will see incrementally margin improving. So these are all the areas that we're working upon. Largely, what we've talked about is H2 will see better margins compared to H1, because some of the strategic support that we called out in Q4 continues to be there in Q1 and may extend even in Q2. But thereafter, we expect that some of these strategic supports that we are calling out should turn into either billing or phasing out beginning Q3. Hence, H2 margins will be better compared to H1. So those are few things which gives us the confidence to get to mid 16% levels by Q4 FY27 or Q1 FY28.
Sure, that's helpful. A clarification question for Amit. With regards to the strong pipeline that you spoke about and the continuous pressure on the European OEM players, do you think probably not FY26, but sometime in FY27 we see a repeat of the kind of growth that we saw in 22 and 23 in the mobility segment?
So again, Manik, we are getting into conjuncture here. We are reading tea leaves too much. My humble request to you, dear friend, is allow us a quarter to come back to you, because there's a lot of play here on auto, like I said, and I am confident that the stack that we have built is there. I am also confident that this is going to come back. In fact, I said that auto should come back by after a couple of quarters. That's what I said. And mobility will come back because of T&OH and Aero. It will come back from Q3 onwards. And maybe Q2 if we win the deals and the ramp up happens. So we're not giving it up.
Sure.
All I'm saying is I would like to make sure that I deliver whatever I commit to you all in a call. We really appreciate your confidence in us. So a little bit of caution there, please.
Sure. Thank you. All the best for the future.
Thank you. The next question is from Karan Uppal from Phillip Capital India. Please go ahead.
Yeah, thanks for the opportunity. A couple of questions from my side. Firstly, Amit, on the revenue conversion. So last 3 quarters were pretty strong from the deal signings perspective. How are you seeing the revenue conversion? Is the revenue conversion on track, or are you seeing some delay due to the macro uncertainty? And second question is on the overall pipeline. So the last 3 quarters have been pretty strong in terms of the deal signings. So should we expect this 200 million deal win number to be a new base for LTTS? Yeah.
So, Karan, thank you. So, Karan, first I would like to confirm to you, our aspiration is to stay at this $200 million LD TCV every quarter. And I, in fact, want to start inching upward. And I'll tell you what we have changed. Once we have gone to these segments, the 3 segments externally and 7 segments internally, we kind of now have 7 sales organizations in the company. So I do expect this to start bearing fruit and growing as we go forward. So that is.
Members of the management, we can't hear you.
Yeah, I'm sorry, Karan, don't know what happened, but I'll repeat. So, Karan, to answer your questions straight, the $200 million LD TCV should be considered as something that we will continue to try and deliver as you go forward. We've got, with the segment approach, we've got LD teams in every segment, and we expect this to continue to fire. Number 2, in terms of pipeline, we have a robust pipeline. It's grown quarter on quarter and year on year. Not just that, order backlog, because of this TCV closures, has increased year on year for us and quarter on quarter as well. Now, in terms of execution, we are more or less on target on execution. You can see that in the sustainability growth that you are seeing. Also, I would like to confirm to you that outside of Smart World, the company quarter on quarter has grown sequentially as well. And that is a result of the pipeline getting converted. Like I mentioned, in the automotive segment, there were pauses and some delays that our clients wanted in specific cases and some program cancellations. But that is a one-off from just automotive. Other than that, the rest of it is all in line and growing.
Okay. Just a follow-up, outside of SWC, you mentioned the company has grown. If you could quantify how much is the growth there?
We don't do that, Karan, but I can confirm to you that the swing of SWC in quarter 4 was there. And we hope that as we go through the year and we start getting Middle East revenues, some of that will go away. But that is work to be done as we move forward into FY26 and beyond.
Okay. And last question is on the top clients, there has been a decline across top 5, top 6 to 10, and 11 to 20 client buckets. Could you clarify what happened there and what's the outlook on top 20?
See, that was largely driven by the automotive decline that you saw in revenues. See, if I look at it, mobility, right? So see, if you take the percentages out, the degrowth was what, about 2 million? 1 point something? 1 point. Right? So 1.x was the decline in mobility that we had. So if you look at it, T&OH and Aero grew to make up, and automotive came down, right? So overall was kind of, I mean, we want to be nice, kind of flattish, but yes, a little bit of decline. But if I look at it, that has what has impacted some of these accounts. But I would not be worried about this. Kindly give us a quarter or so, you will start seeing some of this improvement. In fact, part of my commentary, I announced that we will in quarter 2 hit our first 50 million ARR account yet again, and it will start reflecting because we report trailing 12 months to you, but we see ARR ourselves. So I would like to provide you confidence that you will see this improve. I would not be too worried about it at this stage.
Okay, thanks, Amit, and all the best.
Thank you, sir.
Thank you. Before we take the next question, a request to participants to please limit your questions to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from Vibhor Singhal from Nuvama Equities. Please go ahead.
Yeah, hi. Thanks for taking my question. Amit, just want to understand the SWC part a bit more here. As you mentioned that outside of SWC, the business grew. Now, we've typically see, we just have two data points. I think in both years, in FY25 and 26, in Q1, our revenue fell by around $10 million sequentially. Assuming that is all attributable to LWC, is this a seasonality that we're going to continue to see going forward as well, that we'll have basically a ramp up in Q4 and then a sharp ramp down of almost $10 million in Q1? Or do you think this is going to come down over a period of time as we sign more deals? Just an outlook on that, because I think overall our business continues to be stable, but this is the one which is probably dragging the numbers down.
Sure. So, Vibhor, thank you so much. And, you've been a guide and a coach to us as well as we move through the years. So, Vibhor, number one, SWC swing this year from quarter 4 to quarter 1 was greater than $10 million. And it was made up by the growth of ltts heritage business and IS organic growth as well, because IS also came at a certain base. We have had to grow IS, right? So IS grew, ltts heritage grew. SWC, the swing was greater from quarter 4 to quarter 1, right? And the swing, so we've been able to manage it a little better. Now, had automotive not given us a surprise, you would have seen a much smaller swing in terms of the decline, right? So that's the reality. Having said that, we are working hard, Vibhor, to stabilize this. We are very choosy in the contracts that we are bidding for in SWC. We are trying to even it out by getting more work from Middle East right now. In fact, I want to request Abhishek, who's our director, to talk about this as well a little bit. And then there's the other business, Vibhor, with the segmentization and more people in the large deals team, more people in the sales team, and US and Europe starting to grow for us. We believe that when you come to Q1 of FY27, the decline should be lower or not there. Our intent is to have not there. Here, Abhi, if you can please add on Smart World, the solutions and what we are doing.
So I think, thanks, Amit. A couple of points. I truly believe that our growth in the international segments, US and Middle East, and the kind of deals we are seeing there, US especially in the data center side and Middle East led by platforms on Fusion and another platform that we're building on computer vision. These are the kind of deals which will be more service heavy, and that should reduce the swing that you're seeing. But again, this is something that we're working on. The pipeline is good, but till it converts, it's not converted. So let's hope that in the coming quarters we're able to do much better on this.
You talk about this vision thing?
Yeah, that's what I'm saying. The computer vision platform they're building. So what we have done is the last 7 years of work we have done in smart cities. We have more than 50 use cases of various smart city solutions. We are building a platform where we intend to have a model studio where not just our models, but even customers can try out their models, their data. This is work in progress. We should be able to release the MVP shortly. And from there on, a sandbox where customers can play on something ambitious. And of course, based on what we have uniquely achieved in the industry, and this platform is what we intend to take to the market in the coming quarters.
Got it. Thanks for that very comprehensive answer. And looking forward to a much lesser decline in F1 to FY27 as you just promised, Amit. Just one quick follow-up for Rajiv. In fact, just two quick questions for Rajiv. So Rajiv, I think if I understand correctly, SWC business has traditionally been, and when we acquired it also, it is a lower margin business. So shouldn't Q1 automatically have a margin tailwind if SWC business ramps down in that quarter? We didn't see an expansion in Q1 last year and this year as well. So could you just take me through the math as to why, despite lower SWC revenue, we see basically flattish margins in this quarter or nothing in, let's say, a kind of a jump in margins?
So I think spot on, Vibhor, and I think I was expecting a question like this. So really what has transpired is, see, SWC business, though you call to be relatively lower margin, still has an impact on the overall margin, right? So there is a decline on account of SWC seasonality impacting the margins. But what you're also seeing is that strategic support that we've called out continues in Q1, right? There are other programs that Amit highlighted in terms of auto that also face some headwinds, right? You had some program pauses. So there is more than what we've had to deal in Q1 compared to Q4. And that's essentially where you see that despite these headwinds, through the LTTS heritage business, particularly wins in sustainability and growth in sustainability segment, we've been able to marginally improve EBIT margins, and essentially that's where it is, right? Now, if you really break this out and play forward Q2, Q3, we are anticipating some of these headwinds will phase out, leading to improvement in margins, Vibhor.
Got it, Rajeev. Just one last bit. The cash flow in this quarter was quite weak. I missed your original comments. Anything to worry about, or just basically a quarterly thing and some of the cash flows maybe spilled over to the next quarter?
Yeah, Vibhor, I think it might sound a similar response. Actually, this is a SWC seasonality effect, right? Much like revenue, you kind of see an uptick because we're in projects kind of business. Of course, with milestones being delivered, that follows through with higher cash payment. So you will see the uptick. You will see cash improving from here on. You would have seen a similar pattern in Q1 last year, where we had negative cash flows, but we recovered to deliver almost 108% of free cash flow all of FY25. I mean, hoping to get there, if not 100, at least do 90% plus free cash flows.
Got it. Great. Thank you so much for taking my questions, and I wish you all the best.
Thank you.
Thank you. Before we take the next question, a reminder to participants to please limit your questions to 2 per participant. The next question is from Ravi Menon from Macquarie. Please go ahead.
Hi, thank you for the opportunity. Congrats on the strong last deal wins. I just wanted to check on, the tech segment, where you said that you extended some support to customers. Is this in semiconductors?
Can I request, Ravi, leave it at tech and let us do it?
Sure. Just wanted to understand the dynamic here, because it looks like, there is a little bit more of that this quarter compared to last, because QOQ, despite SWC seasonality, margins have gone down in the tech segment. So that's why I wondered if this is, it's become a little bit more widespread. Is it more customers or a larger extent of support?
No, it's not wider customers. There are 2 specific customers. And like we had told you last quarter, Ravi, this was a Q4, Q1, and potentially a little bit in Q2 support that will be done, and that is the end of it. And there are various other measures being taken in the company that we are taking, and that is why Rajeev confirmed to you that from an EBIT trajectory, H2 will be better than H1. And it's our goal to try and get there. There's a lot of work being done right now and work in play.
Right. Thanks. As a follow-up to Rajeev, once we
I also,
the intellectual...
One more thing. Ravi, also please keep in mind that the new age solutions that we are launching, etc., we've got a robust pipeline in all 3 segments, mobility, sustainability, and tech. If some of these deals that we're expecting closure on get closed quickly in the quarter earlier, before the summer holidays, it'll help us as well. So various things being worked on, Ravi.
Thanks so much. I appreciate that. Rajeev, if once you've passed the Intelliswift acquisition, how should we think about the seasonality of margins in our business here overall, considering SWC? Should Q1 be the low point, and or Q4 be the lowest for margins? How should we think about seasonality for margins?
So, Ravi, tempted to almost say that, look, Q1 is the bottom in terms of margins. What probably we are little wary about is, is there any further shocks to absorb in Q2? Having said that, I think we've got, enough and more to be able to improve margins from here on, right? So you will see gradually margins improve. The reason we are calling out Q2 is because you're still seeing some of the dynamics being played out from a macro standpoint. But we're hoping Q2 is the last quarter, and then we'll see margins improving thereafter.
All right. Thanks so much, and best of luck.
Thank you. The next question is from Sandeep Shah from Equirus. Please go ahead.
Yeah, thanks for the opportunity. Just a clarification question. The guidance which we have given for a double-digit growth in this year, we are reiterating, but the last time in the earnings call and the press release, we have mentioned about constant currency, versus this time the press release does not mention a constant currency. So is it any assumption change in terms of a full year guidance this time?
No.
Okay. So one can fair to assume the guidance is based on 4Q FY25 rates.
Huh? 4Q FY. Yeah, absolutely. Yes, sir.
Okay. Okay. And directionally, one can assume this growth would be more back-ended rather than second quarter may pick up significantly.
Need to be worked. I mean, internal goals are much higher. You say man proposes, God disposes, right? So to be played out, my friend. But all we say is that H2, see, you will see growth in revenue from here on. No second doubts about it. Now, how much can we grow in Q2 and then take to Q3 and then to Q4 is to be worked.
Okay. Okay. And Rajiv, just a clarification. This quarter we had 11.9% in terms of a SG&A, which I agree because of the lower revenue base. But you are saying one can model 10.5 to 11.5. So what are the extra things which we are doing beyond a growth as a lever, which will decline into SG&A as a cost?
So, Sandeep, I think part of this, and if you do go back few quarters, we've been running at that 10.5 to 11% SG&A clip, right? The increase in SG&A from quarter 4 was largely because of IntelliSwift, right? IntelliSwift being a smaller company had higher levels of SG&A. As part of the integration plan, we are continuing to look at opportunities on optimizing and also efficiently managing some of the SG&A costs. So what you will naturally see is that we come in between this 10.5 to 11.5% range, and that's the reason I'm guiding to model in that range.
Okay, thanks and all the best.
Thank you. The next question is from Dipesh from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Just two questions. First, on the IntelliSwift, can you provide, let's say, how the integration playing out and the growth rate, momentum playing out, pipeline and other things? Because when we acquired, I think we have a very ambitious target to scale the business in 3 years. If you can provide some update on that. Second question on the clarification side. Last quarter, we said organic growth to be better in FY26 compared to FY25. Are we maintaining or we think because of weakness in some of the segments that might be tough? Thanks.
Okay. Divesh, thank you. So first question on Intelli that you asked. So we've created a 3-year, in fact a 5-year plan for Intelli. And so Intelli, you can divide up into hyperscalers and ISV business, which was 2/3 of the business. Or half of the business. And half of the business is in retail, fintech, non-banking institutions, which includes private equity, and providers, and pet care, right? So that's the area that they play in, or we play in with Intelli. Now we're doing 2 or 3 things. Immediately what we have done is, we have taken the hyperscalers, combined it with our hyperscalers and going full hog at that. And we have actually now launched about 40 AI agents and about 6 agentic AI tools that can be leveraged for hyperscalers. In the other 3 subsegments, which is retail, fintech, non-banking, which includes private equity, and in providers and pet care, we have engaged with doing a strategic plan of how can we make each of these 3 subsegments to $100 million each in 6 years. And that is in play right now. We remain comfortable and confident, right, that the growth will be there and is there right now with a pipeline, right? So that is number 1. Number 2, your question on FY26, I'm reiterating two statements. Number one is that we will have double-digit growth. Number two, we continue to work on making sure FY26 will be a better year than FY25. Sustainability is already helping us to deliver that. We are choosing where else do we get the other stuff to be able to deliver, but year to be played out, my friend.
Thank you.
Thank you. The next question is from Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just a clarification. In the quarter.
Mr. Jain, your voice is breaking. We can't hear you very clearly.
Yeah. Is this any better?
No.
No.
Hello?
Yes, much better. Please go ahead.
Yeah. So my question was, we saw good new client addition in the quarter. Is it led by IntelliSwift or, and if yes, then what is the contribution of this unit in the quarter?
No, the new client addition that we have had is, and part the new clients that we added into Intelli must have been added in quarter 4, right? So this is new client addition in addition. There have been teams that have been working hard, my friend.
So you are saying this is across the board, and this must be smaller deals because the larger deal cumulatively accounts for the bulk of that. Are these coming as a smaller deal versus what we used to prune the accounts earlier versus now scaling some smaller size accounts?
I understand. So I heard you, Rahul. Are you asking, are we going after smaller accounts as opposed to larger accounts? Just give me a minute. Let me look at the report exactly what you're referring to. Just give me a second, please. So Rahul, I think I got what you're referring to. So Rahul, if I look at it, our quarter 1 FY26 has 200 clients that are $1 million plus. Last quarter was 194 and 1 year ago was 177. See, this 194 is the new base with IntelliSwift. So from there we have added 6 more into quarter 1 that are $1 million plus. Rahul, if you look at it, some of these accounts will move up, right? So there will be addition that we'll see if we look at. There are specific clients that we are wanting to acquire, right? That we will acquire because we have a must-have logos, need to have logos list that we have got, plus existing clients will grow. So both will happen. I also want to confirm to you our whole strategy of wanting accounts that are $1 million plus. In fact, we try and say that if a client is not a $1 million client annually for us in about 4 to 6 quarters, we don't want to be able to continue unless we are working on a specific technology area because it is not a viable thing for us to do. So it's a stated policy within the company, respectfully to clients as well. So that has not changed, Rahul.
Yeah. So Amit, why I was connecting the two is because the net active client addition is 38 versus, it was very static, prior to this transaction. So that's why I was just thinking that most of it might have come in the nature of this business.
No, Rahul, in fact, I would like to confirm to you that 194 is including Intelli. So the jump between 177 and 194, which is because of Intelli, correct? And the 194 to 200 is there. Now you must be also referring to total number of active clients. That is from 429 to 459. See, because there are 7 sales teams in the company now rather than 1 unified sales team. So there will be more action that you will see. And as you see, the pyramid will grow up and our whole goal is to go deeper to scale build larger relationships, and so you will see more progress.
And just one last bit on the our aspiration of Q4 27. I know there is some time for that, but given the way macro are shaping, this very strong deal win that you are having, we're not seeing the revenue ramp up. So would it be prudent to, have a different timeline for that goal? Or you think it is the growth in the subsequent year could be much better, and that's why it's fair to stay with that number?
So Rahul, I think good point. I mean, we still would like to stay with that timeline. Like I mentioned earlier, I think, there are parts to this timeline. One, of course, is the IntelliSwift integration, which is indeed panning out well, which of course gives us the comfort. The second, like we talked about, we are seeing a lot of large deal wins in sustainability segment, right? So along with plant engineering, we are seeing a turnaround in industrial products also, which gives us the comfort. We believe that some of the strategic support is more short term, right? If I were to call out, and beyond Q1, Q2, it should phase out, right? So we will continue to hold the timeline. If there is any, let's say, worsening of the global environment, then we'll call it out. At this stage, the basis remains the current global environment.
Right. Thanks for the color, and congrats on winning consistently strong deals despite this kind of environment. Thank you.
Thank you, Rahul.
Thank you very much. That was the last question in queue. I would now like to hand the conference over to Mr. Sandesh Nair for any closing comments.
Thank you, Dev. Thank you, everybody, for joining us at this late hour in the evening. And if there are any of the questions which are still remain to be answered, we will connect offline. Thank you, and take care, everybody. Thank you.
Thank you very much. On behalf of L&T Technology Services Limited, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.